Welcome back, traders. So let's get started. This advanced trading strategy consists of 3 basic instructions that we must follow. Firstly, it's crucial to spot a valid single-candle liquidity sweep pattern on the higher time frame. Moving on, in the second step, we shift to a lower time frame to gain a clearer perspective on the price action and search for any signs of a change of character in the market behavior. Once we confirm the market structure shift on the lower time frame, we proceed to the third step, setting up our entry. Now that we have a general outline of the core steps involved in this advanced trading strategy, let's delve into the details of each step, starting with how to accurately identify a valid single-candle liquidity sweep pattern in the market. In the bearish scenario, the bearish liquidity sweep pattern is formed by the single candle that sweeps out the liquidity above the previous high, including sweeping the high of the preceding candle. This particular pattern tends to occur just before a rapid and substantial downward shift in the market. We look for a liquidity sweep characterized by a long wick or body, followed by an immediate and sharp downward price movement. It is crucial that the price sweeps the liquidity above the highest point of the previous structure, using only one candle body or wick. Additionally, the subsequent candle's body or wick should not exceed or close higher than the first candle's body or wick. We want to see an immediate reversal in price direction, with the price returning to the range below the high after the liquidity sweep. In the bullish scenario, the bearish liquidity sweep pattern refers to a single candle that sweeps the liquidity below the previous low and also the previous candle's low, occurring just before a significant upward movement. We look for a liquidity sweep characterized by a long wick or body, followed by an immediate push in price to the upside, with the price returning to the range above the low after the liquidity sweep. A bullish single candle liquidity sweep is considered valid when the price action sweeps the liquidity below the previous low, using a single candle's body or wick. It is important that a second candle's body or wick does not form or close lower than the first candle's body or wick. This indicates a strong upward momentum and reinforces the bullish potential of the pattern. Before we proceed to analyze real trading examples and see how we can apply the steps of this strategy in the real price chart, let's take a brief pause to understand the psychology behind this strategy. This will help us establish a solid understanding of how price movement occurs in the market. To illustrate this concept, let's suppose we have structures like this that simulate price movement. If we take a look at this structure, we can see that price initially experienced an upward movement and broke the previous structures to the upside and has created bullish BOSs. Additionally, it created these demand zones, each with the capacity to potentially reverse the price direction upon its approach. Following the sweeping of external liquidity, the price changes its direction to access internal liquidity. This action aims to fill the gaps that were previously left unfilled. In the subsequent, we can see price pushed downwards and reached the upper demand zone, and formed a tiny upward reaction, which is attributed to the buying pressure of traders who entered the market with long positions from this zone. This minor pullback further induces more price action traders to enter the market by going long and placing their stop losses below the demand zone. This collective activity creates a well-defined liquidity zone positioned just below the inducement zone, awaiting the market to sweep it. Traders who have placed their stop losses within this liquidity zone are providing a potential fuel source for the market's momentum. In the following, we can see that price pushed lower and already swept the liquidity below the recent low, with a valid bullish liquidity sweep pattern by using a single candle's body or wick, followed by an immediate push in price to the upside, with the price returning to the range above the low after successfully clearing the liquidity through the sweep. So, we've identified a valid bullish liquidity sweep pattern, presenting a high probability opportunity to potentially execute trades. So, why do we consider this pattern as a high probability setup? We consider this pattern as a high probability setup because in this scenario, the liquidity below the recent low has already been swept. This means that many stop losses have been triggered, leading to a sharp increase in buying pressure. Additionally, the price has started to move upward with significant momentum, indicating a strong bullish bias. Furthermore, it's important to note that there is no significant liquidity pool below this zone due to the aforementioned scenarios. What's the core mindset behind this strategy? The core psychological principle driving this strategy is that when sell-side liquidity is cleared out through a liquidity sweep, the price is then drawn towards the buy-side liquidity, which is aligned with its prevailing direction. When price sweeps liquidity on one side, buy or sell, it often triggers a shift in market sentiment. Traders are then inclined to follow the momentum and seek opportunities on the side where liquidity hasn't been swept yet. This strategy aims to exploit this psychological behavior, leveraging the dynamics between liquidity zones to identify potential trade setups with favorable risk-reward ratios. Now, if we shift our attention to a lower section of the screen, we come across an order block located at the extreme. Now, the question arises, will the price head towards the extreme demand zone, or will it reverse after creating a confirmed bullish liquidity pattern? Notably, in this scenario, you don't have to wait for the price to reach the extreme order block before entering the market. Many traders make the mistake of waiting for the price to reach this extreme order block, expecting it to mitigate the extreme demand. However, in this scenario, the price ignores the lower order block and instead creates a bullish liquidity sweep pattern. It shows a change of character on the lower time frame and sharply moves back to the upside. Traders who wait for the price to come back down and mitigate the extreme demand often miss the trade opportunity. It's crucial to note that this unique trading setup doesn't require waiting for price mitigation of any order block or demand and supply zones. In this approach, trades are executed promptly as soon as valid bullish or bearish liquidity sweep patterns are recognized in the market. Now we have identified a valid bullish liquidity sweep pattern. Our next step is to switch to the lower time frame, closely monitor the price movement, and patiently await the formation of a valid change of character pattern. After detecting the confirmation of market structure shift on the entry time frame, we can set our entry position on the newly recognized order block, in this case, a demand zone on the lower time frame, which is created by the change of characters wave. Alternatively, we can set our entry position on the fair value gaps attributed to the change of characters rally wave. Deciding between these entry models is entirely up to you. However, I strongly advise conducting a backtest over a minimum of 6 months in the market before implementing any of these entry strategies. This way you can assess which model yields superior outcomes and make an informed decision based on the empirical data.